Hey, Saretsky here. Welcome back to the show. Lots to touch on this week. We got some updates from Mark Carney. We got some updates around affordable housing and how they're going to work on that housing situation here in Canada, as well as what's happening with Canada's inflation rate and how that's impacting Canada's mortgage market, which is really an important tell all for real estate sellers in this country. Again, this is something I've been harping on for quite some time, and I think it's really, really important to emphasize in this week's video. So I'm going to walk you through all of that for this episode. But as we talked about in last week's episode, we talked about new housing minister, former mayor of Vancouver, Greg Robertson, when he came out last about a week or two ago now, saying that house prices didn't need to come down. We could build affordable housing and we could have affordable housing without house prices coming down. So again, basically what the mayor is saying is he's essentially trying to ride two horses with one ass, which is to say that you cannot have affordable housing and maintain house prices at the same time. But of course, this is the political games and the political reality that we live in, which is the fact that the boomer generation that has amassed large amount of housing equity, that has basically planned their entire retirement off of the value of their homes. I mean, this is a generation that has gotten rich off of selling each other ever more expensive houses to each other, borrowed on credit. And so the game must go on. And so governments are basically saying, listen, we've got to maintain. We actually heard Mark Carney out this week saying, listen, yes, that's one segment of the market, is his words. That's one segment, is that resale market. But we're focused on the affordable housing market, which is to say government subsidized housing, which is what their plan is, to basically build this government subsidized housing. Again, it's not housing that you will buy and own. It is housing that the government will cooperate and run with the private sector, and you will basically rent from them. So again, no such thing as affordable home ownership in this country, as the government has made emphatically clear, which is really interesting because if you look at house prices relative to incomes, Canada is off the charts. The house price growth. Again, in Canada, house price index at G7 inflation adjusted home prices, going back to 1985, shows that Canada really is the leader in this segment, and it has become basically a very unaffordable housing market. And based on what our policymakers are telling you, is that they want to maintain those home values. And in fact, if you look at it and say, okay, well, let's just assume that house prices don't decline, right? Governments are saying, listen, we can't have house prices decline. People's retirements are depending on it. Well, Mike Moffat, friend of the show, has done some research suggesting that it would take 18 years to return to more affordable home price to income ratios. While in places like Ontario and BC, where I'm located here, it would take roughly 25 years. So again, you really cannot have affordable resale homes that people want to buy and homes that people want to loan and live in, take a mortgage out on. You will not have affordable housing without some price declines. Now, again, as we talked about in last week's episode, house prices are in fact declining. The decline is working its way through the system. National house prices are down again 18%, 29% in inflation adjusted terms from the peak. This is a real substantial correction, the largest of which we'd have to go back to the 1980s and 90s to have seen. So the correction is playing out in front of our own very eyes. And there's one thing that I've talked about on the show for quite some time, which is to say that, listen, there's a lot of sellers out there that are making critical mistakes that I think maybe unfortunately don't listen to or watch this channel, because I try to look at it from really both sides of the aisle. You guys will understand that, when I feel it's an opportune buying time, or when I feel you have to kind of navigate the market, I do my best to at least try to filter through the data and give people advice, which is to say the most common thing that I heard from home sellers. You guys remember I talk to home sellers on a daily basis. We run a very successful real estate sales team here in Vancouver. This is what I do for a living. So I have to chat with people on a daily basis. And again, not everybody watches this channel and is maybe educated on what's happening in financial markets, what's happening in the bond market. But the number one thing that I heard, not just from some of our clients, but industry colleagues of mine, their clients, the number one thing that you hear in the marketplace is rates are coming down. There's no need to panic as a home seller. Rates are coming down. Why cut your price? Because rates are coming down. That was all over the Globe and Mail news articles, over Global News, CTV News. That was all you heard. Hey, listen, the Bank of Canada, they're expected to cut rates this year. They're going to cut rates, 4, 5, 6 times this year. So the rate cuts are coming. The housing market's going to restart. Home prices are going to start going back up. There's no need to panic. And the one thing I've emphasized from day one is, well, hold on a minute. The vast majority of Canadians don't borrow at the short end of the curve. They don't borrow based on the overnight rate, which is what the Bank of Canada controls. They borrow based on the bond market. The bond market is what essentially prices Canada's fixed rate mortgage market. If you're looking at your 5-year mortgage, which is the vast majority of Canadians, is what they take, is they take a 5-year fix, or some cases more recently they've been taking 3-year fixed mortgages. That's based on the bond market. It has nothing to do with the Bank of Canada and cutting rates. And so you can have two simultaneous scenarios where you have the Bank of Canada cutting overnight rates, cutting short-term rates, which impacts your variable rate mortgages. But you can have the longer end of, or the belly and the longer end of the curve, which is your 5-year mortgages, push higher. And so what we've seen, if you actually look at it today, 5-year fixed rate mortgages they're really not any cheaper today than they were at the start of the year. In fact, they're actually moving back up once again. If you look at the Canada 5-year bond yield, it's clipping close to about 3% today, which is exactly where we were in January of 2025. So you have a range bound yield in Canada's 5-year. So what this essentially means is it actually hasn't really gotten any cheaper, really, for the vast majority of Canadians that are either renewing a mortgage or taking out a new mortgage. And so the demand picture, you could argue really hasn't improved, particularly when you start layering on the tariffs and the job losses that the Canadian economy is now feeling. And this is where most Canadian home sellers have gotten caught. They've gotten behind. They're behind the curve, focused on the last sales comp from 6 months ago, not realizing that inventory has been stacking up and stacking up and stacking up, where the fact where you're now at 5 months of inventory nationally, but you've got pockets of segments like in the GTA and like in Greater Vancouver where I'm at, where you go to the Valley and you go to pockets like Burnaby and Surrey, where you have all-time record high condo inventory for sale. There's never been more condo inventory for sale, and it's piling up and piling up and piling up because nothing is clearing. There's very little liquidity in the market, and inventory is taking so long to sell that it's just stacking up and stacking up and stacking up, and nothing is clearing. This stale inventory is just building as the new inventory comes on and adds to it. And this is the number one mistake that sellers have made, has been too slow to react, largely on the premise that rates are coming down. There's no need to panic. And that really, again, has not been the case this year. And part of that is if you look at inflation in this country, the headline inflation for last month came in at what, 1.6%, but core inflation, which is the measure that the Bank of Canada is actually focused on, core inflation has been moving higher over the last 3 months. So you've got the scenario of sticky inflation in Canada. It's actually showing up the most in food prices right now. That's pushing core inflation higher, and it's pushing bond yields, the reaction to that sticky core inflation and the data that's coming out of the US. What we're seeing in global bond markets, not just the Canadian bond market, but global bond markets, are blowing out the long end of the curve. Basically, bond vigilantes, the bond market is worried about government deficit spending. There's too much government borrowing. There's too much debt out there. They're starting to demand a higher rate of return. They're demanding a higher interest rate at the long end of the curve, and it's pushing yields higher and higher. So again, despite what central banks do, is you can be, again, very well in a scenario where fixed rates, mortgage rates move higher, despite what the Bank of Canada, the Fed, or whatever central bank wants to do, because governments have no ability to rein in spending. There's too much supply of government bonds, and there's not enough demand for it, pushing yields and interest rates higher as well. So that's really what's happening in the housing market. Again, very little liquidity. It's interesting, just sort of anecdotally. Again, do this for a living, chat with realtors on a daily basis. Some of the biggest names in the space here, and the conversation today is more and more of us are actually opting to turn down turn down listings. It's very, very rare in the industry that you ever hear a realtor turning down a listing. But you're in a market now where you're accumulating all of this inventory. Think about it, you're accumulating inventory as a realtor. You're always fronting all of the costs and the marketing costs in advance. So, for example, if you're signing up just a generic listing, you might spend a couple $1,000s on photos, floor plans, marketing, advertising for this listing, servicing it for 2 or 3 months, spending 20 hours on the listing, only to find out you finally bring the seller a somewhat reasonable offer and they turn it down because the expectations are up here and they're not adjusting with the market. The market is what determines the value of your home. It's not me as the realtor. It's not BC assessment tax authority that determines the value. It's the market. It's the market participants of the buyers and the sellers that determine the value of your home. And so what you're seeing more realtors turning down listings and saying the seller's expectations are too high. I can't afford to continue to accumulate more inventory. I'm only going to work with the motivated and the realistic sellers. Because again, it is taking. It's not a 1 week process to sell a home. Those are bull market days of 21, 22. It takes 6, 8, 10, 12 weeks now to sell a property. You got to put in the work. And you're going to work that hard only to find out your seller is completely out to lunch on what they're willing to transact at. It is a wasted not only of time, but of upfront capital. So you're seeing more of that in the industry. You're also seeing some realtors now discussing putting clauses in listing contracts saying, listen, if we take on the burden of paying for all the advertising, etc., and we list you for 2-3 months and you decide, you know what, I'm out, I want out of the contract early, I'm going to go rent it out, or I'm going to take it off, give it a couple months to breathe, then try to get in the fall, maybe I'll hire somebody else. Some of them are now looking at clauses to say, listen, we'll pay for it, but if you terminate early, we want a reimbursement. We want a reimbursement of marketing costs for these listings. Because again, I'm seeing scenarios I know in the industry where you can have, particular realtors that work in particular fields that will spend thousands of dollars in advance up front for these listings. I know of realtors out there that have monthly overhead for some of these high-end luxury type of realtors that are spending budgets of 30, 40, $50,000 a month in overhead burn between advertising, bus stops, brokerage signage, etc. There's assistants, admin teams, $50,000 a month, and if nothing is moving because you're in a liquid market, which is particularly the case at the higher end, it's basically this like slow bleed out. So it's really interesting. I think that what we're getting is ultimately a much needed purge in the industry. There's no doubt about that. There's way too many realtors, and probably 80% of them, in my opinion, are not very good. Let's be honest. So you have sort of the top, in my opinion, the top echelon that are worth it, that know what they're doing, and then you have way too many people. I mean, what is it in the GTA? 50,000 realtors in the GTA. I think in Greater Vancouver, between the Greater Vancouver board, Fraser Valley board, I think you're close to 20,000. I think that's a number that realistically can and should and is coming down. And so it's interesting. These are the interesting sort of moments in the space, challenging but create incredible opportunities as well. And so you're getting a rebalancing. You're not only going to get a rebalancing in the development space, you're going to get a lot of these fly-by-night developers that everyone thought they were going to come in and get rich. Those guys are all going bankrupt now today, small, medium size in particular, which is actually ironically going to benefit the big names that sit on large swaths of land. They have a lot of cash. They can kind of come in, scoop up a lot of these delinquent sites. And so there'll be the great purge, not only the development side, but I think on the realtor side, on the mortgage side. And so you're going to get this rebalancing, not just today, but over the next 18 months. So as always, that's kind of what I'm keeping an eye on this week. Hope that helped, and we'll see you next week.